Hello traders, let us take a perspective on Fibonacci retracement. Fibonacci retracement is another technical tool often used by professional traders to analyze price movement when trading. On this chart, you can see various blue lines that map out some levels including 23.6%, 38.2%, 50%, and 61.8% among others. These levels typically denote the Fibonacci retracement levels on this spot dollar chart. They are the critical areas where the currency price is likely to reverse or experience pullbacks according to Fibonacci retracement tool. As you analyze the markets, or when you are studying market analysis by professionals, you'll often notice instances where they denote that the market is likely to bounce or reverse once the price reaches specific Fibonacci levels like the ones including the ones that we have mapped out on this pounded dollar chart. It is therefore important for every Forex trader to understand what Fibonacci retracement means. And also, you should also ensure to understand how to successfully apply the technical analysis tool when you are analyzing the market before you can take your trading positions. Typically, Fibonacci retracement is a technical analysis tool used in Forex trading to identify potential levels of support and resistance based on key Fibonacci ratios. It is worth mentioning that the Fibonacci tool is named after an Italian called Leonardo Fibonacci. Leonardo Fibonacci introduced a sequence of numbers in the 13th century where each number is the sum of two preceding numbers, the numbers being 0, 1, 1, 2, 3, 5, 8, and so forth and so on. There are ratios that are derived from these numbers, which include 23.6%, 38.2%, 50%, and 61.8%, among others. These ratios are usually the basis of Fibonacci retracement. In Forex trading, Fibonacci retracement is applied by drawing horizontal lines on a price chart between two significant points. That is, the points are usually a swing high and a swing low. These lines usually correspond to key Fibonacci levels that we have mentioned, including 23.6%, 38.2%, and so forth, and so on, and act as potential areas where the price might experience a pullback or a reversal before continuing in its primary trend, for example, an uptrend in this pound dollar chart. To choose for the levels where to apply the Fibonacci tool, as a trader, you will look for significant swings in the price. That is, either a clear high and a clear low. In an uptrend like the one on the chart, you draw the retracement levels from the lowest point to the highest point, while in a downtrend, you draw the retracement levels from the highest point to the lowest point, depending on the time frame that you are interested in, such as 4-hour, daily, 8-hour, 1 hour, 15 minutes, and so forth and so on. But basically, on the time frame that you are interested in. Let's take an example in a bullish market to try and understand how the Fibonacci tool would be employed when trading. So on this chart, there is evidence, or you can see that as the currency price rises, it eventually takes a breather before continuing in the uptrend. That is, the market moves up, then goes down slightly, moves up again, then goes down, and so forth and so on. Typically, this is where Fibonacci retracement tool becomes useful when trading. So what traders do is they draw lines on the chart from the lowest point, like the ones we have drawn, to the highest point of the trend with the help or using the Fibonacci retracement tool. Once you do that, the tool will give you the potential levels, mapping out clearly. As you can see, we have 0.0% up there. There is 23.6%, there is 38.2%, 50%, 61.8%, and 100% from where we began drawing from. These lines give you the potential levels where the price might retrace, and this will denote point where you can take positions once the market retraces. Probably if it retraces to 50%, now you can take your buy position to continue in the uptrend, so you'll be able to gain your profits as the market continues to trend upwards. So now let us take a look at some of the steps that are employed, or steps when a trader is applying Fibonacci retracement tool in Forex. So some of the essential steps, as like you can see, is you begin by identifying the trend. Is the trend an uptrend or the trend a downtrend? The next thing is selecting swing points. So you identify a key point where the market swung, probably a low or a significant low and a significant high. That is where you go to the next step, that includes drawing the Fibonacci retracement levels. So when you draw the Fibonacci retracement levels using the Fibonacci retracement tool from, in this chart, from the swing low to the swing high, since it is an uptrend. And if it was a downtrend, you draw from the swing high to the swing low. Afterwards, you go to the next step, that includes observing the potential reversal levels. So as a trader, you have to pay attention to the potential retracement levels that we have mapped out, or the one that we have been discussing, including the 23.6%, 38.2%, and so forth and so on, since these levels are the potential areas where the price might reverse or where it might consolidate. So the next step is you look for confluence. So basically what you'll do, you will combine Fibonacci retracement with other technical analysis tools and indicators such as trend lines, support and resistance zones, candlestick patterns, and so forth and so on, so as to increase the probability of speculating accurately. So the next step includes confirmation. So in this case, what you do is you wait for additional confirmation signals before you make your trading decisions, or rather before you take your positions. Some of such confirmations could include price action at the Fibonacci levels, or signals from other technical indicators. Finally, as you take your positions, you have to factor in risk management. So in this case, basically, what one does is you ensure to implement proper risk management strategies so as to protect your capital, so that in case the market does not go according to how you have speculated, you don't end up blowing your entire account. So that's it about Fibonacci retracement. But would like to conclude by mentioning that Fibonacci retracement is a versatile tool, but it is essential to use it in conjunction with other analytical methods and consider the overall market context. In most cases, traders often find it helpful for identifying potential entry points, stop loss levels, and areas of interest for profit taking. Thank you for watching. Let us meet again in the next trading video that we will be uploading in the coming soon. Thank you.